These whales sold over $30 million worth of S&P 500 puts. And interestingly enough, these were for the May 1st and May 6th expiration. Both of those expire this week. And even more interesting than that, this week on Wednesday, May 1st, is FOMC. That's where all the monetary policy and financial conditions are reviewed. This happens basically every month, as I'm sure many of you are familiar with. And orders like this are telling us something very useful. And I'm going to show you on a chart right here. So you can see this is the S&P 500. There's actually a couple things that I identified first, just based on technicals. We actually are in a bear flag. As crazy as that may sound right now, I'm just going to show you a basic idea of it. It's not perfect. The one on QQQ is a lot better, but we still have a bear flag here. We have the breakdown from earlier, if you remember that last week. This is basically distribution up here, and then we had the breakdown, and I'll show you with this horizontal ray where we broke down from. This was a key support. We broke through it on April 15th, and then we've been unable to get back above. So we saw this sell, and now we're in a relief bounce period right now. Again, this is not necessarily a perfect bear flag, but the principle still remains the same, that we're within some form of a channel. And until either it breaks to the upside or to the downside, we won't see a continuation move. That's where these orders that I just showed you come into play. Whenever you see this sheer amount of premium for also opening orders, which we can identify in either this in the opening tab, as you can see here on these prints, or also we can look at the volume to open interest. Just because the volume was much higher than the open interest on these orders means that these were being sold to open as well. So there's two ways you can identify it. The first is volume is greater than open interest, which is why it says opening here on Cheddar Flow. The second, a little bit more difficult, you have to look into the implied volatility. That's the IV of the contract to see if it actually increased while these were being sold, or it decreased ahead of it. Just because the volume is over the open interest in this case, it's a lot easier to identify these as being sold to open. And the reason why these are important is because it gives us basically a floor for next week when we have that FOMC decision. And what I mean by a floor is, look at the strikes that I just showed you on those orders. They're between 5,015 to around 5,040. And in order for these whales to get paid next week, they have to see a close by the expiration, roughly speaking, above these strikes. Now, it's not going to be necessarily exact because there's other factors that can influence it. They also could trade these so they could get out on Monday. Let's say if the price continued to climb or stayed where it was, above where their entry was. However, for simplicity's sake, and because this seems to be a pre-FOMC related trade where they're targeting something like FOMC or maybe heightened IV heading into FOMC, I'm going to treat it as if they're going to hold into either the March 1st date or all the way into the end of the week, which would mean, again, that this would act as some type of a floor. They don't expect it to get below because, let's say on FOMC, they're still holding their contracts. If we're well below this range, let's say we're under 5,000, then they would lose on this position. So with that being said, we know that there's some type of a floor around here. And based on a potential trade for this week, we would know that our risk would be somewhere under where this box is right here for a couple reasons. One, these whales are not getting paid, and they're definitely wrong if we see this crack below the 5,015 to 5,040 range. So that's the first thing. So we don't have that confirmation bias of it either staying propped up here or having continuation to the upside. And then two, the bear flag I just showed you right here, we have a valid support on the lower end. Again, I know it's not a perfect one like I just said, and I actually can show you very quickly over here on QQQ what's more interesting. This is a perfect bear flag that we have here. We have the top, as you can see, connects all the way across. So we have a nice resistance here as well as over here, and lastly right here. And then the lower end, it starts right over on April 22nd, and then you can draw it across as well. This is a much better bear flag. We have the flag pole right here. It's range bound at the moment. And as long as it stays contained below the upper end of this range, we can see a potential breakdown if it can get under roughly 425 right now. So this is a perfect bear flag in my opinion. SPX will follow similarly. It's not necessarily the best, but still, we do have a valid support right around here, which would be a convergence with QQQ testing around 425. If both of those levels can break, the range of interest for the whales is unable to hold, we can see a flush. Otherwise, as long as it can stay above roughly, let's say 5,030 to 5,050, where all of these supportive prices are, we're likely going to see a bounce. And with that information, we can now develop a trade thesis. So let's say FOMC, we still see the open interest, still shows that the whales are in, then we can know that they're going to want to see, again, this stays propped up. So if we have a retest after FOMC of around that 5,030 to 5,050 range, there's a potential long setup with a stop being around a 15-minute close below 5,015. Because if we go back below 5,015, especially on a 15-minute close, hourly would be even better for confirmation. It's probably going to continue to the downside because both this range as well as this trend line were broken. So we're looking at about 15 to 25 points of risk for potential upside of a lot more, because if this continues after bouncing off around this range, we can see upside of around 5,160. That'd be just the top end of this bear flag that we're in right now. And even though it is a bear flag and you're likely to see some type of a breakdown from those, you can still trade inside the range because there's a lot of points that can be made. Because again, this is from around, let's say you entered around 5,040 at the top end of this box. You're looking at over a 100-point move to the upside just within this channel alone. So there's still a lot of opportunity within the channel. And who knows, maybe it even breaks out to the upside afterwards. That's not my base case, but still, just for the principle of this video, it really boils down to there being a lot of potential to trade off of levels like this, especially when you have confluence with both option strikes as well as technicals. It's a beautiful confluence together. It's what I like to identify. So I know that this range over here, especially going into and out of FOMC, assuming that these contracts are still open, it's likely going to act as a key supportive range. And again, I can base risk off of that as well, because whales are not going to want to see this get back down below their lowest strike. So with that being said, this range will act as a useful over-under bias. Basically, under would be bearish throughout the rest of this week. And then as long as it stays over, this will act as a support. And we can see continuation to the upside. So now that we have that out of the way, one more thing I wanted to share is dark pool data from last week. And interestingly enough, I'll show you here, if you filter from start of the week to the end of the week, we didn't see that much in terms of overall premium. We saw 1.9 billion here at 508.44. Remember, we're anything under, let's say, around 2.5 billion. Actually, anything between 1.5 to 2.5 is just okay. It really isn't anything eye-catching, and it's nothing that I would identify as being rare. Anything under 1.5 is definitely not a lot. So with that being said, 1.9 billion, it's not that much. It's just kind of an order for the week. So nothing too much to write about for that one. As we scroll down here, you're going to see similarity right here around 2.6 billion. So again, nothing too eye-catching. The most eye-catching out of the week is 4 billion at the 505.50 level. So this will be a critical level going forward, because again, anything above roughly that 2.53 billion range is something you definitely want to keep a tab on. So this, of course, fits that nicely. And then as we scroll down here, you'll see some other ones, 2.7 billion, 1.6 billion. These are both together. So this is a decent amount, and this is at the 503.30-ish range. So it's another level of interest. And as I scroll down, you can see for the rest, 2.1 billion. So nothing too insane there. And one of the days was, I think it might have been this day, or it might have been a bit lower on the week. There was only like 800 million for signature dark pool prints. Yeah, I think right here. So 878.9 million. So very, very low day in terms of overall premium at the 495.20 level. So nothing too interesting there. The two most important prints from last week, the ones I showed you here at this 503.30 level, as well as the 505.50 level. So the last thing I'll do here is go over to SPY's chart. I'm going to mark both of these levels just to get a sense of where we are right now. I'll go use the horizontal array. We have 505.50. So I can draw the first line here. And then the other one was at that 503.30 level, as you can see from right over here. So with both of these levels, the first thing that I notice is that we closed the week above. So that's a good sign, at least for bulls, especially from a dip buying sense, because if we do retest between this range, this can act supportive as long as it stays above. The next thing that I've noticed is this looks like an interesting range compared to what we just saw on SPX, and that's because it is. If you go down here to SPX, you can see the similarities because SPY is tracking the S&P 500 index. You can see here we had where this lower end of the range is, and then we had where this lower end of the range is on the S&P 500, and you can see that's the 503.29 level, and a bit higher is the 505.51, right around where this gap level is. So both of these dark pool prints, especially the 503.31 from down here that I showed you, is right about where this range or supportive range is on the S&P 500. Again, another factor that you can take into account for it being a supportive range right around this 5,040-ish level, something to add to the confluence for this week of this being supportive. It just increases the probability of a bounce from something like 5,040, 5,050 right around here, because you have multiple variables that are converging with each other. They're all going to assist to act in a supportive nature if price decides to fall down to around here. And as traders, it's always great to see multiple variables converge together to assist your trade thesis. That's what's happening in this case. Again, short term, at least for continuation to the upside, we want to see this range here on the S&P 500 hold. The whales are also in a similar boat, like I just showed you from earlier. Going back to those orders, is what we saw right here. 30 million plus of those put sell orders. They don't want to see this get back below the strike of their choice going into the expiration. So they're going to want to see continuation to the upside, or at least price maintain above this level. They'll be able to profit on that in the short term. And that's the key there. This is a short-term trade for them, as well as what I just shared with you today. This is only valid for this week, because beyond this week, we can certainly see a lot more play out. These whales will be out of their positions. And like I just said, with the structure we have right here, this is technically a bear flag on both the S&P 500 as well as what I just showed you on QQQ. I'd assume this would have continuation down once it breaks here, but the initial test of this supportive range around here on both QQQ and S&P 500 is likely going to be some type of a short-term bounce with that continuation. But other than that, as always, appreciate you guys watching this video, and I'll see you next time.